Many times, the art of investing may be reduced to a handful of simple guidelines that everyone can use to succeed financially. However, both doing and not doing things can lead to success. Our feelings may make the task more difficult. Although the saying, buy low, sell high, is commonly known, human nature often causes us to behave in the opposite manner. Create a set of golden rules that will lead you through the challenging moments as a consequence. While the market is experiencing a bull run, anyone can profit. But those that have a long-term plan that works are the ones who prosper and thrive in choppy markets. Here are 10 golden rules of investing to follow to make you a more successful and hopefully wealthy investor. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Stay in the game, have an emergency fund. You must keep an emergency fund on hand in order to stay invested for the long term and to get through challenging times. Because setbacks happen in life, keep 5% of your assets in cash, suggests Craig Kirsner, President of Retirement Planning Services at Stewart Estate Planning Wealth Advisors in Pompano Beach, Florida. It makes sense to have at least 6 months' worth of expenses in your savings account, the author claims. If you have to sell any of your investments at a difficult time, it's possible that you will do so at a loss. You might be able to extend the amount of time you spend investing if you have an emergency fund. Cash should always be kept in cash, ideally in a high-yield online savings account or a certificate of deposit. Compare prices to get the best deal. Number 9. Review your investing plan regularly. Even though it can be a good idea to build a strong investing strategy and just make minor adjustments to it, it's a good idea to constantly examine your plan to make sure that it still matches your needs. You could do this each time you review your accounts for tax-related purposes. Kevin Driscoll, Vice President of Advisory Services at Navy Federal Financial Group in the Pensacola region, advises clients to keep in mind that their initial financial plan won't be their last one. You should review your plan at least once a year, especially after significant life events like starting a family, moving, or changing jobs. Number 8. Understand everything you invest in. According to Chris Raleigh, founder and CEO of Harvest Returns, a fintech platform for investing in agriculture, avoid investing in a product you don't understand and make sure the risks have been fully conveyed to you before investing. You must comprehend how whatever it is that you are investing in operates. Understanding why buying stocks makes sense and when the stock is expected to perform favorably is crucial when doing so. Before making an investment, you should think about a fund's track record, expenses, and other factors. It's crucial to understand how annuities operate and your legal options before purchasing one. Number 7. Avoid timing the market. As shown in popular culture like television and movies, experts typically advise customers to avoid trying to time the market or make a purchase or sale at the ideal time. The saying, time in the market is more important than timing the market, is increasingly common. The premise behind this is that in order to make substantial returns, you must remain invested rather than often entering and exiting the market. The Wells Fargo Investing Institute's Veronica Willis, a specialist in investment strategy, offers the following advice. The greatest and worst days generally correspond with periods of market volatility, such as a bear market or an economic crisis. If an investor wanted to be in the market one day, out the next, and back in the next, they would need to trade with expert precision. Experts often advise making frequent purchases to benefit from dollar-cost averaging. Number 6. Stay diversified. To lower risk, maintaining portfolio diversification is crucial. No matter how well they have done for you, it is risky to only have a few companies in your portfolio. As a result, experts suggest diversifying your investments. Mindy Yu, a former director of investing at Stash, advises investors to think about diversity as an investment strategy. By diversifying your holdings, you can better withstand the ups and downs of the stock market. The good news is that sometimes it is simple to achieve variety. A portfolio's diversification will be accelerated by an investment in a Standard & Poor's 500 index fund, which holds hundreds of interests in the leading American companies. To further diversify your holdings, you can add a bond fund or other possibilities, such a real estate fund. The performance of these funds may vary depending on the state of the economy. Number 5. Keep your investing discipline. Investors should keep saving over time, even if they can only do so in little quantities, under both difficult and advantageous economic conditions. If you keep up your regular investment, you'll develop the habit of living within your means while steadily accumulating assets in your portfolio. The 401k, which automatically deducts money from your paycheck without your consent, is the appropriate vehicle for this discipline. Below are instructions on how to choose your 401k assets. It's crucial to choose assets carefully. Number 4. Buy when everyone is fearful. Investors frequently sell during bear markets or simply stop paying attention. But that's also the busiest time for sales. There is no other market, it is true, where products are offered for sale but no one wants to buy them. Be fearful when others are greedy, and greedy when others are afraid, as Warren Buffett once advised. The good news for 401k investors is that once your account is set up, there is nothing else you need to do to keep making contributions. Your emotions are kept out of the equation by this design. Number 3. Stick to your process. According to Sam Hendel, CEO of Easterly Investment Partners, the finest investors develop a method that is consistent and productive over several market cycles. Stick with the known and tested, even if there are temporary setbacks that make you question your abilities. One of the best investing approaches is the long-term buy and hold strategy. In a 401k, you may, for instance, routinely invest in stock funds and hold them for many years. But if the market starts to sway, it could be simple to veer from your course since you're momentarily losing money. Number 2. Think like an owner. Chris Graff, co-chief investment officer at RMB Capital, says, thinking like an owner. Keep in mind that you are investing in both businesses and stocks. Even though many investors view stocks as a game of chance, they are supported by reputable businesses. Stocks are a form of partial ownership in a firm, and over time, whether a company is profitable or not, they are likely to go in the same direction. A piece of advice from Christopher Miser, CEO of Vivaris Capital in La Jolla, California, is to be conscious of your motivations when investing. Do you place bets or investments? Valuation, fundamental analysis, and performance projection are just a few of the many activities that make up investing. Graff advises making sure the company has a strong management team that is supportive of shareholder interests and that it is in good financial and competitive standing. Number 1. Never lose money. Let's start by paraphrasing the first guideline of the late, great investor Warren Buffett: never lose money. Never forget rule number 1, according to rule number 2. The Oracle of Omaha's counsel emphasizes how crucial it is to guard against portfolio losses. Your portfolio will be more profitable if it has more capital. Consequently, a loss reduces your earning potential. Naturally, it is simple to state, don't lose money. According to Buffett's rule, one should consider an investment's drawbacks in addition to its possible rewards. The investment might not be profitable if the risks you are taking do not outweigh the potential rewards. As a result, a lot of investors are staying away from long-term bonds at the moment. Buffett first advises concentrating on the negative. Effective investment requires making the right choices and avoiding the incorrect ones. Maintaining your composure in the face of all of this is essential if you want to inspire yourself to act morally even when doing so feels risky or unsafe. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.